Well, good morning, everybody, and thank you for attending today's GPSA webinar. Today, we're talking about the federal budget and its impacts on agribusiness and farmers and growers itself in South Australia. Um, the budget was handed down on the 12th of May, some 35 days ago, and literally as we are presenting today on Thursday, the 18th of June, Treasurer Jim Chalmers is also standing up at the same time and making changes to those budget announcements, budget reforms that he announced some 35 days ago. So this webinar, although timely, is probably 1 hour too early to be true to what's actually going to happen. Nevertheless, we're gonna persist because we don't think the broad strokes of what the budget was, as announced a month and a bit ago, has changed. Um, and so, without further ado, I'll present Daniel Proctor from William Buck, who is the principal of the business advisory team there at William Buck. He assists his clients with financial advice to help them with planning and strategy and growing their agribusiness, and he works across South Australia. So, Daniel, latest breaking news: Jim Chalmers is literally announcing carve-outs for capital gains tax reforms. But nevertheless, can you tell us what your take on the budget some 35 days ago was, please?
Thanks, Brendan, and thanks for having me. Yes, very inconvenient timing for Jim Chalmers to come out and decide to amend things, but we'll press on with what was announced initially. I might send out a little bit of a summary sheet afterwards in terms of what's changed to the slides, but as a bit of background, we at William Buck are the largest accounting advisory firm, locally owned firm in South Australia, with a key focus on agribusiness, whether it's grain growers, pastoralists, or ag tech. Getting into it. So what's in store for today's session? Now there is a bit of
And you'll get to share your screen, mate. Share your
oh
screen.
yeah, bit to cover off here. Sorry. Bit to cover off here, but essentially, want to go through what's happened over the last month or so, why it matters for farmers, get into the weeds a little bit on the CGT and trust measures, because it will affect most of our clients and I'm sure most of you online, and just a bit of a hit list of what you guys need to be thinking about before each of the different milestone dates. So what's happened the last 6 weeks or so? So as Brendan mentioned, on the 12th of May, we had the federal budget, and there was a pretty comprehensive budget in terms of changes they want to make to a whole bunch of things, but importantly, a lot of tax adjustments, with proposed changes to both CGT, taxation of trusts, negative gearing, as our key metrics here. There were also some other things touched on during the budget in terms of R&D offsets and changes to that, legislating the instant asset write-off to be $20,000 going forward, and a reintroduction of the loss carryback rules for companies. These might apply to some or most people online, but for the moment we'll just focus on the CGT, the taxation of trust and negative gearing in this presentation. Important to know that on the night that there was no draft legislation written at the time, there was a bunch of fact sheets provided and some commentary afterwards. However, no draft legislation we can hang our hat on. But it's probably important to know that these changes are quite big, and it's probably the biggest tax changes or structuring changes that will be required, certainly the last 25 years or so since GST was introduced. So it's important for all business owners to really understand how it impacts them. A couple of weeks ago, we then had certain legislation introduced to Parliament, two bills covering most of the CGT changes that were proposed, the negative gearing element, the WATO, the Working Australians tax offset, and the $1,000 standard tax deduction rules. So a couple good wins there for working Australians, but significant changes in terms of the CGT proposals and negative gearing. Following a bit of commotion in Parliament about it. It was referred to the State Economics Legislation Committee, and those hearings have been occurring this week, with a report due out tomorrow on any potential changes or carve-outs, which I am anticipating is what Jim Chambers is currently talking about. Importantly as well, for trusts and associated businesses, the Bendel case, which you may or may not know much about, with the High Court decision was handed down last week. This case has been going on for about 7 years and tackles distributions from a trust to a corporate beneficiary and whether that loan is captured by Div 7A rules. I won't spend too much time on that at the moment, but it is a significant change in terms of how trust profits can be taxed. Why does it matter? Well, I guess, like I said, his proposed measures are big and it does hit at the core of mid-market private group structures, which definitely covers most of our farming clients throughout our business. I definitely haven't picked up a file in the last 6 weeks where I said, oh, this wouldn't apply to them. It's going to apply to most people. But at the essence, it's tackling CGT and trusts. Every discretionary trust will need to be considered going forward, whether it's still effective or if it needs to be changed. And how we, I guess, structure asset holdings, investments, and the like going forward will need a fundamental rethink. There won't really be a one-size-fits-all solution for everyone. We need to kind of weigh up the different elements in terms of how income would flow through a structure, how it's taxed, what are the impacts on asset protection, how do we move assets between generations in terms of succession planning, how do we fund operations. So the proposed changes have added a lot of complexity, and we would recommend you be talking to your advisors, hopefully William Buck advisors, about this ASAP. I'll quickly touch on negative gearing because we have a number of clients that will be impacted by this, and it's a common question. So effectively, proposed changes are from 1st of July 2027. Negative gearing will not be available for existing residential investments. And these losses, instead of being offset against other income in your name, will just be quarantined to then either be used against other rental income or capital gains on that property if it's sold in the future. That applies to individuals, partnerships, companies, and most trusts, and affects all residential properties except for new builds. And they proposed changes to write it into legislation, a distinction between what is a new build, not just a significant improvement or a subdivision or something like that, versus a new residential dwelling. So we're waiting on some confirmation on that. And importantly, there are some exclusions proposed that if you did already hold a property that is being negatively geared at the time of the budget, you can continue to do so. So it is being grandfathered to a point. But after that date, if you buy an investment property and look to negative gear it, it needs to be a new build that adds to housing supply. They have also proposed a bunch of exclusions in terms of it. You can still apply these rules to commercial properties. You can apply these rules to shares and other investments and the like. So I won't spend too much time on that, but important changes to make note of. The first big one here, though, is capital gains tax and how the government wants to, I guess, get a bigger piece of the pie from any capital sales along the way in the future. The biggest things here is that the 50% CGT discount will look to be replaced by a cost-based indexation method, and removing the CGT discount for all future sales from that point. They're expecting a 30% minimum tax rate on capital gains. So currently, even if you're at the top marginal tax rate in your personal name, the worst case scenario would be that you'll pay 23.5% on any capital gains, being the top marginal rate less the discount. So that's a big step up. And most importantly, especially for farming families that have carried forward farmland for a number of generations, any assets purchased before September 1985 or pre-CGT assets are now going to be brought into the regime from 1st of July 2027. Important to note that the small business capital gains tax concessions haven't been touched under the original proposals. I did just hear that some of the revenue tests might be changing on this per Jim's announcement today.
Daniel, sorry to interrupt, Daniel. From the headline I can read here, small business CGT turnover threshold is to rise from $2 million to $10 million.
Brilliant, which is
It's probably what is
important because that hasn't been
good
indexed
news
for a long
for
time.
a lot of listeners.
Yeah, so that's important to note that even with the change to the discount, there are still exemptions out there and available to small businesses. As Brendan just said, less than $10 million of turnover. And there's a potential to reduce any capital gains on those assets to zero. So definitely speak to your advisors on that part. Probably skipping ahead and assuming some things here. Bit of a quick CGT lesson for people that maybe don't have a lot of tax background, but essentially what is a capital gains event, or how do you calculate a capital gain in the first place? You've got capital proceeds, so the amount that you've actually received for selling something, an asset, whether it's land, shares, property, etc. You've got your cost base, essentially what you paid to acquire that asset in the first place, plus any associated costs such as stamp duty. And then if your capital proceeds are higher than your cost base, you have a capital gain. And then from that capital gain, you then work out the tax on that gain. Where there's capital proceeds less than the cost base, we have a loss. So that's pretty simple. But yeah, the net capital gain is what is taxed and included in the taxpayer's income. So the current system is fairly simple, that you work out your capital gain. If you've held the asset for more than 12 months, you get a 50% discount, and the remaining net capital gain can either be attributed to individuals or a company or whatever it is, an ultimate taxpayer. And there may also be some small business CGT concessions available to reduce any tax payment as well. So like I mentioned, the existing rules allow the reduction of a 50% reduction on any capital gain where it's held by an individual or trust, and it's held for at least 12 months. And importantly, you're an Australian tax resident. However, this is what's being targeted by the government. The changes here, we're looking at replacing the CGT discount as a blanket, everyone gets this, to a cost-based indexation method. So this is important to note that this is proposed to start at 1st of July 2027 and will apply to all CGT assets. So land, property, trusts, held by individuals and trusts held greater than 12 months. So this is a bit of a quick lesson here, but what is indexation? Indexation looks to apply whatever the increase in inflation rate is. So you have to work out a factor and applies it to the original cost base. So the cost base will be matches up with the inflation rates over the period you've held it effectively. What they're trying to do then is tax the difference between what is an inflation adjusted cost base between that and the eventual sale. So they're saying that that's a more correct way to assess the gain on any profits here. The process to do these calculations though is quite complex and will have an impact on a number of people. So just as a very quick example here, I've just said $1.5 million of proceeds on a property that cost $1 million. So we've held it for 5 years and there's been 2.5% annual inflation, which is largely the RBA's target. we can see that just through this very simple example, the tax payable on the new regime is about an extra $55,000 or so in tax. So we can see that this impact is going to be pretty huge throughout all business owners and asset owners. Probably important to note as well that they've introduced a minimum 30% tax rate on all capital gains. So even if you don't have any other income and you're selling a personal asset, usually you get to use your lower individual tax rates along the way to reduce any gains, and your effective rate might be a lot lower than 30%, but the ATO is saying that we want to cap this at a minimum 30%. So even if your normal tax rates are anywhere between 0 and 30%, the minimum you'll pay is 30% going forward. So that's also a big change. There are some carve-outs, and I believe he's announcing a few more carve-outs today, but this is what we've got so far. So going forward, they've also introduced a range of different categories of capital gains, and these categories are going to matter going forward. So gains accrued up to 30 June 2027. So the new rules kick in from 1st of July 2027. So up to 30 June 2027 will all be subject to the current rules. So there'll be some grandfathering of the rules. They're not changing it just on budget date. But there'll be a couple important steps here. What the CGT asset is will be important, as they're introducing 4 new categories of what a capital gain is, and that will determine the gains and losses going forward. And determining the market value of any of your assets at 30 June is going to be critical importance, because you will need to work out what the inferred gain between the time you bought it and 30 June 2027 is. So there'll be a lot of evaluations needed at that point. A high-level timeline here. Essentially, we're saying that we've already gone through a bunch of timelines in Australia for different pre-CGT or CGT regimes. This is just another one. But essentially, the key date here is 30 June 2027. We need a valuation to work out what your assets are worth at that point. You get to use the 50% discount before then, and the indexation method after that. Without getting too lost in the weeds here, any inferred gains up to that 30 June 2027 point will be referred to as deferred residential capital gains or deferred non-residential capital gains from that point. Why this matters is they've structured the new tax losses and capital loss regimes to attack different ones at different levels. And we can no longer choose to apply capital losses where and when we want them. There's actually a procedure that we need to go through. Yeah, following through that. So it's a quick slide here. Again, I don't want to get too lost in the weeds. We haven't got too much time to go through this, but if you wanted to take a quick snapshot, great. But this is the new formula to go through and work out your tax capital gains on any disposals. A bit more complicated than what it was in terms of capital proceeds, less cost base. Does a discount apply? Here's your net gain. As I mentioned, significant complexity has been added to the regime if it gets legislated as they're proposed. And importantly, pre-CGT land is now going to lose its tax exempt status from 1st of July 2027. So very important for that land that we get that valued at that point, and then any increases from that date are then taxable. The minimum 30% tax imposed on capital gains is coming in, being conscious that there is multiple time periods to account for and separate calculations on cost-based elements. So if you do property improvements to your land at a time that's later than the time you bought it, there's an additional calculation for each additional cost-based element, because they all index at different rates, but depending on what quarter they fell into. So it gets quite complicated quite quickly. And yeah, like I said, valuations on all capital assets are being quite important, whether that's property, land, or even the shares in your trading companies or investment companies. They're all going to need to be valued at some point. Alrighty. Quickly touch on trusts, because this is the other big one that's going to impact a number of our clients, a number of people in the mid-market. So what we have today, as we mentioned earlier, we don't have any actual legislation, but we do have some federal budget papers and explanations and a number of comments made by Parliament personnel since the budget through the media and whatnot. But what we do know so far is that from 1st of July 2028, so the year after the CGT changes come into effect, discretionary trusts will need to pay a minimum of 30% tax on their taxable income going forward. And then the individuals or other non-corporate beneficiaries will then receive an offset for the tax paid at the trust level that they can apply against tax in their personal names. Importantly, they're proposing a non-refundable tax credit, which is different than franking credits, which are refundable tax credits. So if you're receiving trust income, but your normal average tax rate in your personal name is less than that, you actually lose the difference, which is an important change. They want to tax trusts and obviously make them less popular throughout Australia. But the trustees will then be required to calculate, report, and pay its tax at the trust level before it passes down. And importantly here is probably one of the biggest changes is corporate beneficiaries will not receive the benefit of that trust tax. What they're proposing is that the offset only applies to individuals as it flows through. If income is allocated to what is historically be called a bucket company or a dump company or a corporate beneficiary, they will not get the benefit of the tax that's already been paid on the income. So effectively, the company will also pay tax on any income, effectively leading to double taxation up to an effective rate of 63%. So from that day, dump companies are effectively dead as we currently see it. Now, there are some exclusions from these proposed rules, whether it's a certain type of trust. So these rules are only focused on discretionary trusts where you can decide where the income goes every year. There are fixed trusts out there, widely held trusts, compliant super funds, disability trusts, deceased estates, and charitable trusts are all excluded from these rules. Importantly for everyone on this call, primary production income is currently slated to be excluded from this 30% tax. But importantly, and I know a lot of my clients, that the income in your trust isn't necessarily always all primary production income. There's other parts of the income that are non-primary production, whether that's interest income, lease income, hire fees, contracting, whatever it is. They haven't really gone through how that's going to be split up going forward yet, but primary production income at this stage is excluded from this blanket 30% tax rate. And there's a few other income items there. They have announced a range of rollover relief proposals. Sorry, they have announced that they will announce those. They've announced that they will announce those. So they're to come. They haven't provided any details on what this would look like, but effectively what they're saying is that if you are trading through a trust at the moment or you own assets in a trust, there is a way to move that into a company or a different kind of structure. But we haven't seen what it looks like yet, and we haven't seen how that will be impacted by state level taxes such as stamp duty and the like. So a lot of considerations going to be needed to be given to these situations as they come out. Again, I'd strongly advise you to talk to your advisors about this to understand how this impacts your personal group. ASIC have also announced that they will allow specific arrangements to support small businesses that wish to change from a trading trust into a company. We'll see what that looks like as well. So I guess what we don't know at the moment is what are the precise mechanisms for collecting the minimum tax. is there going to be a lag between needing to lodge a trust tax return, pay some tax, and then lodge all your individuals or your beneficiaries tax returns? We're not sure yet. What happens to franking credits, and what if the franking credits exceed the minimum tax liability? We're not sure what happens there, and how exactly the expanded rollover relief will work. Got some quotes from Treasury there, but effectively what they're saying is that they want all trusts to be paying a minimum 30% tax going forward outside the carve-outs. And they're really trying to get away from a situation where we're using dump companies or corporate beneficiaries to reduce our tax burden across a year, which I feel is a little bit short-sighted personally. A lot of people would minimize their tax to reinvest in businesses to then grow the businesses, hire more people, etc. So I'm not sure that grabbing all the tax you can is always the best thing on the government's level. Conscious that I'm running out of time here. We do have some quick high-level examples that I might include in the slides that will get shared later, Brendan. But I guess just considerations going forward is that we will need to think about whether discretionary trust is still the appropriate vehicle going forward. What to do with bucket companies? Are they effectively dead from 1st of July 2028? Probably. How does the primary production income versus non-primary production income split work? And how does the impact of the Bendel High Court case recently impact the next 3 years whilst we can still access these? So again, pretty complicated tax concepts, but a lot to think about in terms of how this impacts you and your group. So what should I do? Why is it important? Like I said, structuring has really been targeted here, and we would encourage you to look at your own structures, whether it needs to move in the next 2 or 3 years using the rollover relief that's available or the small business C2T concessions that are currently available. But there will likely be changes for the vast majority of mid-market groups. During this year, I think we're proposing people don't go out making rash decisions. Let's see how it all falls out. Let's see what the legislation looks like. There will be a lot coming out over the next 12, 18 months, I expect, in terms of changes and how we get to 1 July 2027 for CCT or 1 July 2028 for the trust changes. And just don't assume that we can use the same structure we've always used. It's going to be a balance between asset protection, income, tax, stamp duty, succession, like we talked about. There's a lot of different considerations going forward. Between 1 July 26 and 3 June 2027, this is the point where the CDT discount still applies, but cuts off at 30 June. So valuations are going to be very important. Importantly, you don't need a valuation by that date, but just at that date. So I know there's a lot of valuers out there that are going to be quite busy at that time, but just trying to get a fair price on what your assets are worth at that point, just so that you can work out any discountable capital gains going forward. Important to note that pre-CGT assets need to get valued as well, because like I said, they will come into this new regime. And anticipate that there's going to be some legislation hopefully coming out in the next 12 months. We will see. Beyond then, getting ready for the new trust rules to come in from 1 July 2028. Assessing any gains on sales after 1st of July 2027 and appreciating the index method started at that point, but I think what we've seen so far, there's a lot of changes coming. There could be another federal election between now and these rules kicking in as well, which is important to note. So some changes might happen before we get into that cycle. But effectively, as we've mentioned, these changes that they've announced are quite big. They will impact pretty much everyone in the mid-market, which includes most of our farming entities, both from a family farm side of things and a corporate farm structure. So yeah, big changes afoot, and I only have more from Jim Chalmers' announcement today, I'm sure. So if you have any questions on that, I do apologize. It was quite rushed to try and get through a lot of info. But either send it through to Brendan through the Q&A chat, or feel free to contact me. My details are on the screen. Thank you. Oh, of course, the disclaimer that this is general advice and not being prepared for one individual organization. Please get your own advice on how this all applies to you. Thank you.
Daniel, thank you so much for that comprehensive update, mate. Yeah, really hard to do, I guess, update as the live press conference from the PM and the Treasurer is going. So I appreciate that. As Daniel touched on with the disclaimer that whilst the webinar was prepared to inform GPSA members, it doesn't take into account any circumstances that are personal to yourselves. So just always consult with a professional or the appropriate advisor to your circumstances and seek independent advice. This is kind of a signposting thing. Daniel spoke about a number of dates that are very pertinent to either valuing your property or your assets June 30 next year. And also importantly, that announcement of an announcement coming of the, I guess, the transitional vehicle between what a lot of farming and agribusinesses have, in that is a trust structure to be able to involve family members and sometimes all farm income into one structure. We don't know what that looks like yet, but by the sounds of it, they need to get it organised ahead of the 1 July 2028 date. And I'm sure they're working frantically behind the scenes. So thank you very much for that, Daniel. We also have in our presentation today is Charlotte Wundersitz. Now, Charlotte is from the National Farmers Federation. She's had a busy morning with the latest update coming out of the Treasurer and the Prime Minister's office. To National Farmers Federation, Charlotte is their General Manager of Trade and Economics. So this is right in her wheelhouse, and I appreciate your time this morning, Charlotte. Originally from the cropping land of York Peninsula, she's found herself now in Canberra, and she represents grain growers and other ag communities on the federal stage. Charlotte, you've sort of dipped out of this presentation this morning a little bit to try and catch up on what the changes are. Is there anything that you can, I guess, update us on from this morning, but also more broadly what the impact of the federal budget was as well, please?
Morning, everyone. Thanks, Brendan. And yes, my apologies, Daniel, that I did miss the first 5 minutes of your presentation, so hopefully I won't overlap. But if I do, for goodness sakes, just give me a wave. Brendan, to your question, firstly, I might just address the announcement this morning. So you may or may not have seen the NFF has been incredibly active in our advocacy on the really significant changes to taxation that came out of the federal budget a couple of weeks ago. The first cab off the rank in regard to the reforms legislation-wise is the changes to capital gains tax and negative gearing. So they're in a bill that's about to go to the Senate next week. The key ask from the NFF has been that we raise the small business concession eligibility so that a broader range of farm businesses have access to concessions, which would mitigate what we think the impacts of the changes to CGT will be on farm businesses. And I think, as Daniel really well articulated, provide a little bit more certainty in what is now an incredibly complex and convoluted CGT tax regime. So the Treasurer, and we had advance notice of this morning, which is wonderful. The Treasurer and PM have just announced that they're uplifting the turnover threshold for one of those concessions, so the 50% active asset concession, from $2 million to $10 million, which will now capture 99% of farm businesses in Australia, giving them access to a concession which will, and I'm looking at Daniel to correct me, partly return the CGT regime, or make it a little bit more consistent with what we've had previously. So still a lot of complexity, and that is yet to pass Parliament, which we're hoping it will do in the next fortnight, but a really significant recognition nonetheless of some of the concerns from the farm sector around how critical getting these settings right is for farm business structures and farm business succession particularly. So I'll park tax for a little bit, and I do have a very short presentation just on the broader federal budget and what it means for agriculture. So I will share my screen. And let me know, Brendan, can you see that?
Yep, that's good. Thank you.
Wonderful. So just going back a step, sorry for launching in case you're not aware, the National Farmers Federation is the peak national voice for Australian agriculture, representing farmers across commodities and regions in Australia. I'd really like to importantly acknowledge that I'm able to present today because of GPSA's membership of Primary Producers SA. So the way in which GPSA members' views are represented in the NFF is through input from Primary Producers SA, of which has been really significant in our federal budget advocacy, and particularly on the tax reform for the last couple of weeks. So Daniel, if you covered this, let me know. But I thought it was important just to quickly address the context of the federal budget, because it really helps explain why it looked the way it did. This budget was delivered in May. It was delivered at a really difficult time globally and domestically. The Middle East conflict was driving, or is still driving, fuel, fertilizer and supply chain disruption. Economically, it's been a really tough environment, which I don't need to tell any of you on the call. Inflation is still elevated, growth is slowing. The government's had a really laser focus on lifting productivity to address some of those concerns. Cost of living is still very much in the rhetoric. So the Australian government sought to deliver a responsible budget focused on resilience and reform to address some of those dot points that I have on the screen there. So with that context in mind, for agriculture, it was a very mixed budget. There were some genuine wins, particularly on fuel and fertilizer security, which became the NFF's central ask from the federal budget, given the immediate pressure that that was posing to farm businesses and farm business profitability. I'll talk a little bit about the win that Daniel has already spoken about on tax in terms of the farm income exemption for discretionary trusts. And there was some ag funding wins, so additional funding for the APVMA, so the Ag Vet Chemical Regulator, which is really significant because they've been under-resourced for a number of years. In conjunction with that, there are a number of cuts that we were deeply concerned about. And obviously, as I've already talked about, concerns. We have some concerns around the broader implications of the tax reform agenda, just because of the magnitude of the reforms and the pace at which the government's aiming to push them through. Importantly, I think as I talk about what's actually in the budget, it's key to acknowledge the current political environment in which we're operating in that with the government having an overwhelming majority in the lower house and only needing the support of the Greens in the Senate to get legislation through, to get budgets through. Success in this environment is often about avoiding a worse outcome rather than achieving monumental wins. So I think that also helps explain some of our framing around what we've achieved in terms of mitigating what could have been worse for farmers. So in terms of wins, as I just alluded to, the NFF really significantly welcomed the exemption of primary production income from the new 30% minimum tax on discretionary trusts. As Daniel incredibly correctly pointed out, there's still a lot of nuance to that and the impact of that measure on farm businesses operating in trusts, but noting that there's 40,000 trusts operating in agriculture, having that exemption for primary production income is a huge win for the sector. We were the only industry sector to have a carve out in the federal budget tax reform suite of tax reforms. So cannot overstate how significant that is. It's been an advocacy item for the NFF for the past 18 months, noting that the taxation of trusts has been in the government's line of sight. Important to remember that there was a lot of uncertainty prior to the budget, so we really welcomed the retention of the small business capital gains tax concessions. We were unsure whether they would be maintained, and it was a possibility that they wouldn't. So it's really pleasing to see them continue. The instant asset write-off has been an advocacy ask and a budget ask of the NFFs for going on 6 years. It's not at the amount that we would like it to be, but the fact that it has been made permanent and now there is potential to continue to negotiate uplift of that measure is also really significant. In addition to the reintroduction of loss carryback provisions. So again, Daniel can correct me, but my understanding is that will be helpful for farm businesses operating as companies to have that measure back in the suite of options. So some wins in what was a really tough tax reform agenda for farm businesses. Again, won't shock anyone listening to this call, but fuel security and input resilience has been almost all we have been talking about at the NFF for the past couple of months. Announced, or rather confirmed in the budget, was just under $12 billion over 5 years for the National Fuel Security Plan. Importantly for agriculture, that's contributing to our supply of diesel. It also includes a fertiliser security facility that enables the federal government to underpin shipments of fertiliser to make sure farmers have their in-season fertiliser needs. So we've been working really closely and continuously with the government on that front. Also will allow Australia to increase its minimum stock holding, which you would have seen has been an issue of significant public dispute. But a lot of this was announced prior to the budget, and certainly in the context of the government's broader spending, a significant bill which they were not prepared to foot if we go back and look at sort of February. So that has drawn money from other places in the budget, and as with a lot of other portfolios, drawn money out of probably measures that could have gone to agriculture specifically to make sure that we address that urgency. So a few other wins, and probably a little bit of asterisks on the trade and export front. There was some money within the Department of Ag, additional money allocated to trade activities, so for international engagement and standards, market access. The government deferred increasing export cost recovery measures, which I don't think will mean much to anyone here, but eventually would be a cost that we think would have been passed to farmers, and they deferred that in recognition of the fuel and fertiliser pressures, which is good news. I say this is a little bit of an asterisk because this measure, albeit it was announced like its new funding, was actually kind of moved money from within the Department of Ag. So positive that we're focusing on trade and international engagement, particularly when you look at some of Australia's major markets and concerns around the EU and some of their agenda. Donald Trump and his tariffs every second day at the moment. So that's positive to see that as a priority for the government. Secondly, innovation, biosecurity and productivity, not an overwhelming amount to report in this space, but I did just want to say that the CSIRO, which does some really important research and development for agriculture, received a really big funding boost because it's been struggling for a number of years. So that should maintain their agriculture and biosecurity research capabilities. And as I said before, I think many of you would be familiar with the APVMA as the AgVet chemical regulator. They've really struggled to keep pace with performance timelines. So processing new product applications, processing emergency permits. I know that's been in the media a little bit recently around mouse bait, for example. So we think that $8 million for the next year is going to go some of the way to helping them improve their operational capability with a view that that would improve their performance and delivery for farmers. I'm mindful of time, Brendan, so I'll be really quick just on our concerns and losses. So we've sort of already covered capital gains tax. The announcement this morning will not fix all of the concerns that we have with that, but it certainly will go some of the way to improving the outlook, we think, for farm businesses. A lot of the NFF's rhetoric around capital gains tax changes has been around succession planning and just making sure we're not creating any barriers for farmers in trying to start a more staged succession planning approach, passing down assets earlier to younger generations and that kind of thing. So there's still a little bit of work to do on that, but really positive announcement this morning. there was really significant cuts to the Department of Agriculture funding, so 191 million. Some of that money was redirected, but I think really relevant for this group is that we came out really strongly in opposition to funding cuts for pest coordinators, so wild dogs, deer, pigs, cats, and the Future Drought Fund. This one was a little bit sneaky, has had a cut of 13 million a year ongoing. I suspect this is going to be a significant advocacy item for the NFF as they try and finalise that over the next couple of months. Other things which I've categorised as concerns and losses, but really were just things that were kind of missing from the budget. So there wasn't a huge amount of infrastructure spend on that was targeted at rural and regional areas of roads. The on-farm connectivity program, which has been a really positive program that gives farmers rebates for connectivity equipment. That round 3 of that program was supposed to run this financial year with a $20 million allocation. That's been cut to 10 million. And like I've got there, no additional funding for roads or connectivity programs. A lot of money channeled into areas that we probably would prefer that it went elsewhere, and I've put up environmental reforms as an example of that. I think that's all my slides, but in summary, a very mixed bag of lollies, for lack of a better way of putting it. Tough for everyone, not just agriculture, is kind of the key takeaway. As some comfort, you know, the Department of Climate Change and Energy had $2.3 billion worth of programs cut. Department of Industry had 300 million, I think. So the Department of Ag's, I'll just stop sharing my screen. Department of Ag's cuts in comparison to that, I suppose could have been worse, if that's any solace. But happy to throw back to you, Brendan, and take any questions on that.
I appreciate it. Thanks, Charlotte. That was a good rundown from a very complex, very taxing budget that obviously 30 plus days on is still being tweaked, still being changed, hopefully to our benefit, which is good to see. And that probably takes some solace of the advocacy that NFF and colleagues have been putting in behind the scenes that have come out today. While I got you both, Daniel, probably just throw to you first. I've only got a couple of questions here, and we're right on time, so this is going well. Daniel, you had a couple of slides there of, I guess, milestone dates. One being 1 July next year, 2027, and the other being 1 July 2028. And from both Evan's presentation last week and from your words today as well, I guess the message, and correct me if I'm wrong, but the message is don't rush to do something today, but certainly start thinking about how you're going to prepare for that first milestone, 1 July next year, given that you've got 12 months of run-up, all the while things are being changed and tweaked in the background by the government as well. Would that be a fair assessment?
Yeah, I think it's just an appreciation that things are changing, and I think the comment around this 40,000 trusts currently in farming throughout Australia is a real thing, and that's going to impact all of them. So we don't want to make any rash decisions, as we said, but there is the likelihood that your structure will need to change at some level, and that an appreciation that there's probably a bigger tax bill coming forward, and that's the new normal.
Yeah, the environment. I mean, this is the biggest reform since probably GST some 25, 26 years ago. So it's a big reform. And as these things are, it's a big shake-up that everyone needs to be paying attention to and adjusting in their own way, depending on their circumstances. Charlotte, your presentation on the budget was a great overview. Thank you very much. One of the questions that came through, though, was there anything for regional connectivity, be it either infrastructure and roads or digital connectivity, given that a lot of farms these days, they know there are things like Starlink, they know that these things are possible, and distance doesn't need to be the tyrant that it used to be, although it obviously has a large bearing on a lot of things. But as your presentation showed, there wasn't, I guess, a great input from the budget to improve those things in case there was a cut to the grant for regional, I think it was black spot, mobile black spot funding. Is that the new normal? As the government sort of run its dash on providing funding for that sort of thing, or was there no other projects to continue on with?
It's a great question, Brendan. So all of the funding for the government's steadfast connectivity infrastructure investment programs is continuing for the next sort of 2 years. So that's when they've had allocations. That's programs like the Mobile Black Spot program, the Mobile Network Hardening program. But there's no additional funding being allocated or longer term funding being allocated. And I think you've sort of answered your question in that because of the introduction of low Earth orbit satellites and technology like Starlink, the government's really thinking about how to best invest in regional connectivity, because the answer now might not be building new mobile towers in rural areas, given how well Starlink is working. So I think part of the lack of investment was due to that. On the giving farmers, direct support for connectivity front, on my comment around sort of thinking about things in terms of the least worst outcome, it was good that we maintained the on-farm connectivity program, which has been really successful in giving farmers rebates to purchase new connectivity solutions for their farm. We have had the advocacy ask for a number of years that program continue as farms become increasingly more integrated with connected equipment. So hopefully that measure can continue. But to your point, no. So no additional spending, but maybe for good reason. And good that program stayed on, which is something.
Yeah, and so whilst we can be, I guess, sad that we didn't get some things we were asking for as a reach request, we can't be unhappy that we didn't lose a lot of things as well, which could have been certainly in the current fiscal situation the government finds itself in, as everybody does. Like you keep on saying, we did the NFF did the best to get the least worst situation, which I think was an achievement in of itself. So thank you. I've got no more questions. Out of today's webinar and the announcement by Jim Chalmers and the PM, if I can ask Daniel to sort of update his information, his slides, with a quick summary of what today means. But I'm going to finish the webinar there. Thank you very much, Daniel and Charlotte from NFF, Daniel from William Buck. And I hope to get this webinar, today's Thursday, hope to get this online tomorrow afternoon. So you can sort of review it and learn more from the slides that both Charlotte and Daniel presented. Other than that, thanks very much, guys.
Thanks, Brendan.
Thank you for having us.
Charlotte.
See ya. Thank you.